In this video, I'm going to show you a mind-blowing trading strategy that deals with smart money and market maker concept. This strategy is based off of the concept or ideology that market makers or smart money create certain patterns and behaviors on the chart with price in order to induce or trap liquidity or trap traders in the wrong direction so as to hit your stops and take your money. In this video, I'm going to be showing you one of the patterns and I'm going to be showing you how you can take advantage of this and make some money off of it. So make sure you like and subscribe and let's get into it. Market manipulation exposed. In this video, I'm going to be exposing some of the ways and patterns in which, or one of the ways and patterns in which market manipulation occurs in the forex market. Now, some of you might believe market manipulation, some of you might not. At the end of this video, I believe you should be convinced, at least to an extent, on the facts and the theory that market manipulation exists in the market, right? So, first of all, the first thing you need to understand is, for those of you that are new, is the market is not random. It is controlled. Everything you see on the chart, the price, everything is controlled and regulated. They can't just leave the market to be random and be moving at any speed or any distance or moving anyhow, basically. So it's regulated and it's controlled by market makers, big banks, hedge funds, and all these big financial institutions, JP Morgan and all those institutions, right? So the market is not random, it is controlled. Now, in order for the market to function properly, there has to be a buyer and a seller. I always explain this analogy. There has to be a buyer and there has to be a seller in the market. All right, the market cannot exist without a buyer and a seller. So they have to be, if someone is buying, it means the person is buying from someone that is selling, and someone is selling to someone that's buying. So for example, if you click buy and sell on your, if you click buy and sell on your dashboard on your MetaTrader, you click buy and sell in the market, you're buying from someone else. You're buying from someone else's order. You're buying someone else's order. If you're selling to someone else, right? And the way it works in the forex market is the market makers or the institutions or the big banks or whatever you want to call them, smart money, they are the ones that are taking the opposite of our trades. Also, brokers to also do this. They have A books, they have B books, right? So they look at the traders that are not performing well and they take the opposite of their trades, right? So that is how it works. They take the opposite of our trades. So when you buy, they're automatically selling. When you buy, it's recording as a sell on the book of the market makers. When you sell, it's recording as a buy in the book of the market maker. So basically, they're doing the opposite of us. So when we lose, they make money, right? When we lose, that's when they make money. So in order for them to make some profit, think about it. If you're a market maker, in order for you to make profit, if that is the scenario, then you have to ensure that you have to make the opponent or the other person behind the screen um buy so that you can sell. And then if you want to buy from them, you have to make them sell so that you can buy. So basically, market makers create patterns and ways in order to create liquidity, get people to buy or get people to sell. That's basically they want you to click that button. All right. So I'm going to be explaining the patterns here. There are a couple of patterns. There are different patterns that they use to manipulate the markets, right? They don't just use one style or one pattern. There are a bunch of different ways and different styles, patterns, behaviors that occur on the charts in order to get you to click that button. There are different ways, different patterns, right? I'm just going to list a few here. The support and resistance levels. These were like one of the main ways in which market makers manipulate the market. I think this was the first one I learned when I was getting into market manipulation, I think like 4 years ago or 3 years ago. I think it was 2020, 2021. I started to learn because the first thing I was learning was support and resistance. I started trading support and resistance. First of all, it didn't work out, and that was when I now found out that market was manipulated, and then I started to learn the concepts on market manipulation and all that. So, support and resistance is the first one. They manipulate the levels, they manipulate the price at those levels. The second one is highs and lows of the day and highs and lows of the week. Right, so at the highs and lows of the day and the week, you're going to notice some market manipulation happening there. You're going to notice that some brokers, not all brokers, some brokers open the spread at the highs and lows of the day. They're going to open up the spread at that point to take out liquidity. All right. You're going to see some spread manipulation there too at the highs and lows of the day. It's not all brokers, just some brokers. All right. The third one is the start of the session, start of the day, start of the week. Also the start and end of the day. Starts and forgot to add that in. And start and end of the session, day and week. So at the beginning of the session, like London session, you're gonna see maybe a false move, market manipulation, liquidity hunt, stop hunts. You're gonna see something like that. Also at the ending of the session, they usually do something like that. So regarding the week, at the beginning of the week, you're gonna notice that Monday, Tuesday, you're gonna see price is gonna go in one direction and they reverse the trend or reverse the trend at the middle of the week, end of the week. Right, so basically that first initial move is the false move or the stop hunt or induction, whatever you want to call it. And then the fourth pattern is Asian range manipulation. You can also call it London breakout. Right, that's where we have consolidation during the Asian session, and then you're gonna have consolidation during the Asian session, and then you're gonna have some form of manipulation coming into London session, also applying the start and ending of each session. So at the start of London session, they're gonna manipulate the consolidation that they had during Asian session. They're gonna manipulate the orders and the people that they trapped in there coming London breakouts. All right, and then the fifth one is wedge formations. Wedge formations. Some of you might not know this. I've not explained this quite much inside my YouTube. I mean, I've touched on it sometimes. For those of you that have watched a lot of my videos, you might have seen me talk about this, but I haven't really dived into it deep like that. So in today's video, this is the one I'm going to be going over. I'm going to be going over the wedge formations. In my previous videos, I think I've gone over Asian range manipulation, highs and lows of the day and week, and I've gone over support and resistance. So in today's video, I'm going to be going over wedge formations and how market makers manipulate the market using wedge formations. All right. Most of you have learned from wedge formations before. When maybe when you were starting to trade forex, when you were learning to trade, you must have seen wedge formation, rising wedge, falling wedge. You must have seen some other weird patterns like cop. I've seen different patterns, different weird patterns with different weird names. I think there's one that's called the flag formation, all those stuff. Those things are irrelevant. But I'm going to be diving into wedge formations in this video. So wedge formations, how does it work? First of all, you need to understand how it works so that you can understand how market makers use this pattern to trap liquidity to induce you to take the wrong direction if you're trading the wedge formations. Now, we all know what a wedge looks like. A wedge basically looks like a triangle, right? And we're gonna have price squeezing to the tip of the triangle like this. This is what a wedge formation looks like. So when you see it on the chart, what you're gonna see is you're gonna see price is gonna form a high, it's gonna form a low, right? These are the base, this is the start of the wedge, right? You're gonna get a high, you're gonna get a high here, and then you're gonna get a low down here. This is how the wedge starts, and then what happens is they begin to form higher highs and sorry, they begin to form lower highs and higher lows. It's like an anomaly in the charts, right? Then this high is going to be lower than this high, and then this low is going to be higher than this low, and then they're going to continue in that format, in that style, till price squeezes and consolidates to a tip, right? And this is going to be the tip of the wedge here. So what usually happens is you connect the highs together. Forgive my drawing. You connect the highs together and connect the lows together, and it's going to squeeze to a tip here. At this tip here, at this point here, is where most people are expecting a breakout, right? When the pattern squeezes to the tip here, you expect a burst in price in either the upside or the downside. Right, that is how wedge formations work. So what usually happens is when it breaks, for example, when it breaks to the upside, people are going to be taking the breakouts. People are going to be buying these breakouts, right? And when price breaks to the downside, people are going to be selling the breakouts. That is basically how wedge formations work. That's how they work. If you don't believe me, let's go on Google and let's hear it from others. Let's see the trading space, what people believe on wedge formations. All right. So here on Google, I searched how to trade wedge formations. How to trade wedge formations. Now, it's proper that you understand that there are different types of wedge formations. There's a rising wedge, and there's a descending wedge or falling wedge. Right. So there's a rising wedge and there's a falling wedge. The rising wedge is basically for an uptrend, I think, or a downtrend. One of them is for an uptrend, one of them for a downtrend. So basically, how does the wedge formation work? So to trade wedge formations, identify the pattern on the charts by drawing trend lines connecting the swing highs and the swing lows. Remember what I told you? You connect the swing highs and the swing lows. So these are the swing highs, and then these are the swing lows, right? So what they're basically saying is you connect the highs together with the trend line, and you connect the lows together with the trend line, and that gives you the wedge pattern, right? So to trade wedge formations, identify the pattern on the chart by drawing trend lines connecting swing highs and swing lows. Then wait for a breakout from the wedge, entering a position when price moves decisively beyond the trend lines, and confirming breakout with increased volume. So what they are saying here is after price has formed the swing highs and swing lows and you've drawn your wedge, what you're going to do is once you have a breakout, you buy. So that's what they're talking about here, entering a position when price moves decisively beyond the trend line. So when price breaks the trend line, that's a breakout, breaking out of the wedge formation. That's where you take a position. For a rising wedge, sell when the price breaks below the lower trend line. So this is a rising wedge here because the wedge is pointing to the upside like this, right? So it's going to be something like this. It's going to squeeze to the top and it's going to break out, and then people are going to be taking sells there. That's this rising wedge. And then for your following wedge, you buy once price breaks the the trend line. All right, so key points to remember when trading wedge formation. So the reason why I'm showing you this is you need to understand how people trade the wedge formation, how the wedge formation work, so that you can be able to understand the manipulation. All right. So first of all, you identify the wedge formation, falling wedge, rising wedge, whichever one it is. All right, then you look for a confirmation. Before entering the trade, wait for a clear breakout from the wedge. Now, wait for a clear breakout from the wedge, ideally with increased volume, blah, blah, blah. Entry points. Now, we need to know where they are placing your stop loss because the liquidity is where your stop loss is, right? We need to know where people are placing their stop loss because that's what market makers are going to go after. So when they enter the trade, when they enter the breakouts, they place their stop loss just outside the opposite side of the wedge from the breakouts to minimize um, potential losses and blah, blah, blah. So what they're saying here is when you have a wedge formation, right? You have a wedge formation and it squeezes to the tip like this, right? Squeezes to the tip. Let's say in this example, you sold, price broke to the downside and you sold. They say put your stop loss at the opposite side of the wedge from the breakout. So the opposite side of this is going to be here. So you're going to put your stop loss here or here. Anywhere within this range, you're going to put your stop loss. So that's where most people are going to be putting their stop loss up here above the wedge. And if you're buying, right, you're buying, you're going to put your stop loss below here, right, on the opposite side of the breakouts. So that's how people trade the wedge formations, right? Now, just to show you a couple of pictures of what this looks like. This is you can see here, this is a rising wedge. This is a rising wedge, and this is a falling wedge, rising wedge, falling wedge. So you can see how they're explaining how the pattern works. All right. So now that we've understood how the pattern works, what we need to now do is identify how market makers are going to manipulate this. Now, how market makers manipulate this is what they do is because people are going to be buying, let's say this breaks out here, people are going to be buying this. And where is their stop loss going to be? The stop loss is going to be below these areas here. So what's going to happen is market makers are going to do like as if they want to go up, right? As if they want to give them the trade, give them the breakout. So it breaks out like this, and what's going to happen is this. So when you buy somewhere in here, price is going to later reverse on you. And then if you're the type that is selling, if it's a sell, this is what's going to happen. They're going to go after your stop loss. So this initial move here is a false move, is a false breakout in order to trap traders going in the wrong direction so that they can induce and then move away from that. Now, some of you might be asking, or some of you that have traded this pattern, you might maybe you have seen where this pattern works in the past. The thing is, they're not gonna just completely waste the pattern. They're gonna make it work sometimes, right? They're gonna make it work sometimes. A trading strategy or a pattern that doesn't work doesn't mean it doesn't work 100% of the time. It works sometimes, but in the long run, it doesn't work. Right? So sometimes they're gonna give you the win. Sometimes they're gonna give you the win so that you can come back. So you have that hope, you have that feel of trust or that hope that, okay, this thing is working. Let me keep on training it. Like, okay, it worked today, so tomorrow it should work. No. What they do is they give you a taste of it so that you can come back for more. All right, so whenever you see a breakout from the wedge, you can most likely expect a reversal going against the people that are chasing the breakouts. Now, let me show you a couple of examples of what I'm talking about. Let me show you a couple of examples of what I'm talking about. All right, so yeah, let's go to examples. So, as you can see here, this is a wedge formation. This is a form of a wedge formation. I think this is a rising wedge, right? So what usually happens is this is the wedge formation. You can see how price comes and squeezes to this tip here, squeezes to the tip here. Now, at this tip, people are going to be waiting for a breakout. I know usually when people trade breakouts, they usually wait for the candle to close. Some on the lower time frames might be entering somewhere here. But if you're trading on a 15-minute chart and you're waiting for a candle to close, most people are going to be selling in here. I know most people use big stop losses. They use big stop losses. All right. And as you can see, price breaks to the downside. And what happens later on? Price reverses back up. Remember, if you're going to be selling this breakout, where are you going to be putting your stop loss? Where did they tell us to put our stop loss? Above here, to put our stop loss on the opposite side of the breakout. Or what happens? Price induces you in the wrong direction to get you to chase the breakout. This is an induction, getting you to chase this move, and you can see how fast it moves. You can see the aggression. So it gives people see this big candle, and people say, "Oh, this is momentum. This is a momentum candle. Oh, this is a momentum candle." So that means price should be going down. The momentum is to the downside. Sellers are winning. All that garbage. So what happens later on? Price eventually goes back up to take out the stop losses of people that were chasing these sells. All right. Sometimes what they do is like what they did here. They will whipsaw you. They'll go in both directions like this and then go in their direction. So this is a false move, this is a false move, and then they move in their direction. All you have to do in order to identify something like this is to understand where you are in the trend. All right, so let's move on to the next example. We have another example here. All right, we have another example here. So this is a wedge pattern, as you can see here. This is a wedge pattern. Price squeezes to the tip here, and then people are going to be taking sells, expecting this to continue down, right? Especially if this is a downtrend. If this is a downtrend, people are going to be taking breakouts here, right? People are going to be taking breakouts here like this. And where is the stop loss going to be? The stop loss is going to be above this area here. So what happens? Price induces the people to take sells, comes to this low, even breaks the low to induce more people to take sells below this low, below this support level. So this is an extra induction to induce you to take sells below this level, traps traders here, and then moves away from this direction. This was the trade I took. I remember I took this trade here. I bought it there, put my stop loss below here because I saw the manipulation. I saw the inducements. I knew that this was an induction, especially as they entered back in here, took a buy, and then took this back up. Let's move on to the next example. Here's another beautiful example here. You can see the wedge formation as price squeezes to the tip here. Remember, I told you that they're going to form swing highs and swing lows. So this is the low, this is the high, this is a lower high, higher low, right? Lower high, higher low, squeezing to the tip here. At this tip now, we expect a breakout. People are going to be taking breakouts here. This is the induction, inducing people to take buys. And then what happens? Price reverses against them. We, understanding market manipulation, we are going to be selling at this high here. We're going to be selling at this high here. And remember, this is an uptrend, right? This was initially an uptrend, so people are going to be convinced that this is the right move, not knowing that this is an induction. They are ready to reverse this trend, and now they're going to be going in the opposite direction. All right, so you can see how they were crawling, giving you tiny candles to go up here, and the moment they get up here, they start giving you huge, big candles going against you. finishing off everybody that took buys in that area. So people that put their stop loss below here, below here, below here, and below here, everyone got stopped out, right? They took out all the stops. Here's another example. Here, they didn't even give room for any profits. If you took a buy here, you're just going to be in for a few minutes, going to see a little bit of profits, and then what happens after that? What happens after that? Price completely reverses. Price completely reverses from that area, taking it down, right? Now, this one, if you put your stop loss, no matter where you put your stop loss on this one, you're destroyed. Like, this price just went all day down. Here's another example. We have the wedge formation here. Price squeezes to the tip, breaks out, false move, goes back down. Stop losses are going to be at these areas here. I don't think there's any stop losses going to be here. Well, stop losses are going to be here within this range. That's where you're going to see most of the stop losses within this range here. You're going to see stop losses because if you have this low here and you have this low, so stop losses are going to be here and here. So within the range, you're going to see liquidity located at this area here like this. So where the price go, eventually, price went to hit the stop losses and take out the liquidity of after inducing people to take these buys to the upside price. So people are going to be seeing this huge move here, expecting price to continue up since they saw that huge move. So they expect this to continue up with an uptrend, not knowing that this is an induction. They created this pattern purposely so that they can manipulate, right? So that's why they created the pattern. They created the pattern so that they can manipulate, all right? And that's what happened there. Let's move on to the next example. We have another example here. We have the wedge formation, squeezes to the tip. Now, this is the example where I told you that they're gonna induce you in both directions. I don't know what's wrong with my drawing. They're gonna induce you in both directions, up, down, and then make their move in the direction that they wanted to. So that's what they did here. Squeeze to the tip, induce people to take buys. If you took buys here, sorry, you're destroyed with this red candle completely took you out. If your stop loss is here, and stop loss is here, you're out. Induce you to take sales again, and then move the market in the direction that they want to move it to. I took this trade here. I bought this trade here. As I saw that price tap the low, this was Monday, Tuesday, low of the week. Price tap this low. I took a buy here, put my stop loss below. I think my take profit was hit around there, right? All because I understand that this is manipulation. This is a false move to the downside. This is a false move. This is a false move here. So I know that once price gives me an entry, I'm entering that trade. Here's another example. The same thing. Here they did the same move here, up first, down, and then reverse back up. Now, this is an example on gold. This one is very interesting because what happened was this. All right. So this is Wednesday, Thursday, and Friday. And if you look here, this is the first week. This was the first week of Friday. Sorry, this was the first Friday of the month. So this was NFP. Right. This was an NFP event. So leading up to NFP, what did they do? They created the starting points of the wedge formations, right? Remember, they started it here, highs, lows. Knowing that Friday was coming, market makers know that Friday was coming, time for them to feast. The news events like NFP, this is usually where market makers have the ability to spike the markets and take out liquidity in both directions. Like they just use the news as an excuse to take out liquidity. All right, that's why you see sometimes on news, you're going to see the up, down, and then you're going to see spikes in both directions. And then at the end of the day, the market doesn't really move in any way. So now you can see like this candle that you see here, you can see price spiked up, spiked down. The reason for that was because they wanted to take out liquidity above and below, right, with the news. So they use the news to do this type of high volatility move, take out people buying and selling. People are trying to chase these news events. So some people are going to be buying, some people are going to be selling. So it's going to take out both of them at the same time. So they created this wedge pattern before the news events, before NFP news events. They created a pattern like this to the tip here, came to the tip here. Now notice what they did at this point. Now this candle here that through that week, that is the news candle. Now notice what they did. Notice the sneaky thing that they did here. They squeezed to the tip of the wedge where we expect a breakout. And what did they do? They started to break out few minutes before the news. They started to break to the downside a few minutes before the news. Now this is gonna get some people thinking that NFP is gonna bust all the way down, right? And the NFP hits. We have liquidity above here. We have liquidity below here, right? So what they did was they induced the sellers, right? They induced the sellers, taking out the stop loss of the people that were trying to chase buys, took out the stop loss of people buying here, induced people to take sells, right? So there are a bunch of people that are also going to be chasing sells. Now remember, this was a full red candle at this point. This was a full red candle at this point. So people are going to be chasing these sells, chasing these sells, chasing these sells. And what happens after inducing people to take sells here? The NFP and these breakouts, what they do? They went back up, taking out the stop losses of people that were selling. Not only that, they also went to this high. They also went to this high to induce people that are trading support and resistance and chasing the trend. Now, this was an uptrend. Gold has been bullish. So people are going to be induced. More people are going to be induced with this move here. Some people are going to be taking breakouts here. What happens? Price reverses back down and then goes back down like this. So take out the stop losses of the people that were buying this. Now, I would have taken this trade, but I wasn't on the chart when I saw this, even though I would have taken this sell here, put my stop loss above. This was a nice move back down after NFP. Right. So these are just a couple of examples of the market manipulation using wedge patterns. All right. So whenever you see a wedge pattern on the chart forming, wait for the breakouts, right? Wait for price to break out. And when price breaks out, wait for the reversal to continue back down. And that is how market makers manipulate the market. So this is just one of the ways that market makers use to manipulate the market. There are different ways. Remember, I showed you support and resistance, highs and lows, start and end of the day, week, month, session. What other one did I even mention? The other ones too in regards to trends and all that. All right, so I created an ebook, a PDF where a PDF called Market Manipulation. Manipulation Exposed. Right, I created an ebook regarding this, and inside the ebook, I go over some other tactics that market makers use to manipulate the market. I go a bit more in depth on the ebook. So if you want to get the ebook for free, the ebook I posted it inside my free Telegram. So if you want to get access to the ebook, make sure you join my free Telegram. Join my free Telegram. You're gonna see the ebook in the pinned comments. Sorry, in the pinned post. So check out the free Telegram. The link is in the description below. Link in this description. So check out the free ebook. You're gonna find it valuable. You're gonna learn a lot of things inside the ebook. So make sure if you join the free Telegram, I also share updates and trade analysis and free education inside the Telegram. So if you're not in already, make sure you join. It's free, and I'll see you guys inside. Also, if you're not a subscriber yet, make sure you like and subscribe. If you want to check out my other videos on market manipulation and the strategy that I used to trade and make money on the forex market, you're gonna find my videos there on my YouTube channel. So make sure you like and subscribe, and I'll see you guys on the next one. All right, peace.